Europa Capital, as most of you will know, is a European investment management business. We've been around for over 20 years. Up until quite recently, we've focused on value-add investing on a pan-European basis. I've been with the business for 14 years. I now sit on the executive committee. Our major shareholder is Mitsubishi Estates, who we are investing for now. So our focus has always been pan-European. At the moment, we are probably a little less focused on the UK and more focused on France and Germany, and that would be true both for value-add and for our core plus initiatives. But we've also taken the view that we want to expand our business into alternative or specialist funds. So we have, again, you may have seen, we've recently bought into student housing in the UK. We have a small debt fund and a debt business which is growing both in the UK and Europe. And we will be doing separate accounts in the core space. So interesting time for our business. We've been through a succession as well, which has been an interesting experience for me. But we're very positive about Europe. And to answer Richard's question, Northern Europe does include the UK. The UK is still part of Europe. So it's UK, Benelux, the Nordics, and Baltics, which is my primary responsibility.
Great, thank you. John.
Thank you. I look after European research at Aberdeen Asset Management. We've got almost 30 billion under management in property. The majority is in the UK, but we have been expanding rapidly in continental Europe over the last 5 or 6 years, and we've been particularly pushing into residential because we see that as a very attractive structural theme. We think essentially in Europe's major cities we haven't got enough housing for the growing populations. Populations are growing faster than housing is being provided, and I think property investors can step in and provide some of that housing. We've grown from less than $1 billion to almost $5 billion under management in the residential space across Europe, predominantly in Germany. And also something that's a bit more opportunistic that we're doing as well, that follows on from that theme, is doing some office to residential conversions as well. So we're doing quite a lot in that space as well, which are a bit higher risk, higher returning strategies as well as the core kind of build to rent PRS developments that we're doing predominantly in Germany.
Great, Robin.
Hello, I'm Robin Carr from AERIUM. AERIUM's been established since 2003. We have a portfolio currently of assets under management of about £3.5 billion. That's a pan-European portfolio. Currently, we're probably most focused actually on the UK and Germany. And in fact, a third of our portfolio is currently in the UK. Very focused on the tech sector, particularly tech sector, offices, and then in Germany, very focused on particular markets like, for example, Berlin. So very focused on certain locations and particular sectors.
So Riccardo Dallolio, I run H.I.G Real Estate for Europe. H.I.G, as a background, is a global private equity manager. We have about 22 billion of equity under management. We invest in private equity, we invest in high yield debt, and then real estate. In real estate, we're about $1 billion in Europe. In terms of investments and strategies, we invest across the capital structure, so not only equity, but also mezzanine, preferred equity, NPLs. And currently, we are investing across Europe. We're quite agnostic about the markets. This is a relatively benign environment in which to invest. We like areas where capital is less available, and therefore when we see big flows of capital, we tend to be net seller rather than net buyers. So at the moment, the Nordics it's a very good market for us. Spain and Italy obviously are also suffering for lack of liquidity, even though Spain obviously has received quite a lot in the last 12 months, and in the UK we're still active across the sectors.
Hi, I'm Richard Divall. As my title says, I head up the cross-border capital markets team for the EMEA region at Colliers. I think hopefully most people will realise that Colliers is one of the only 4 truly global advisory firms. We're in 61 countries. I'm part of the global platform and value add the teams with knowledge of international capital, not just global but also regional, and involved often with connecting passive capital to local partners around Europe.
Okay, great. Maybe just starting with you, John. we've seen the macro picture from Damien, still looks positive for European real estate. We've got sustained low growth, low interest in rate environment, although we've got a tick up in the US coming. What do you see as the impact both for the UK, let's say, and also continental European real estate markets? And let's look at the next 6 to 12 months. Are there particular winners or losers? How do you see that market?
We're a little more cautious on the UK, essentially. We think the political risk has made some international investors nervous. That's certainly an impression we're getting from our Far Eastern clients, I suppose. They're still more cautious. They are still investing, but there's definitely an increased nervousness. In contrast, continental Europe, I think it's still a very positive picture. I think the election of Macron has given a big boost to the perception of France. We've seen investors keen on the French market. There's still, both in the UK and continental Europe, very large yield gaps between government bonds and commercial property as well. So for investors looking for income, there's still a lot of investment demand out there, and our short-term leading indicators are still positive in terms of where values are heading. And we think there's some very positive structural trends in certain sectors as well, particularly industrial and urban logistics and residential as well, where there's a lot of investment demand and strong occupier demand as well.
Okay, good. Riccardo, you, in terms of that picture, winners and losers, you've already said you were looking at Nordics especially. Does any of that macro picture suggest to you anything different for the UK and the areas that you're looking at versus continental Europe?
As I said, in the Nordics, for example, it was a tactical decision and was very specific. It was relating industrial, following the currency correction that we had a few years ago deriving from oil prices. A certain sector, non-oil related, started performing really well. And so we took a tactical decision to invest into industrial and logistics in Norway and in Sweden. So that's the type of considerations we do. So if you talk about the UK at the moment, we look at the sub-market. So, we look at the office sector in London, and we think about the supply side and the demand side, and so we are sitting at the fence. On the other side, other sectors such as residential, and especially residential, the number of niches which we are actually looking into and working on, which actually work really well. So it really depends on the micro picture. So if the question is how are we behaving now, the pound has depreciated substantially, which by the way started significantly below the referendum, right? It started in 2014 at the peak of the pound, close to 170, and now just before the referendum was at 140, now it's 128. So at the end, funnily enough, the biggest correction happened before. So we look at sectors which benefit from the main change in macro condition, and we're also cautious about where the interest rates might go eventually. So we're trying to invest into sectors which are immune to that, and in an area where supply is less of a problem, and therefore we are looking at hospitality opportunities in niche location across the UK. We're looking at resi, PRS or other type of specific residential across the UK, not necessarily London, and we're still quite active in industrial. So these are the sectors for the UK. So our bias is, as we invest across Europe, in our portfolio construction, UK has a big role.
Okay, good. And Robin, you mentioned that you're focused on UK and also Germany at the moment. Do you see the differences that were pointed out, that the UK investment has dropped and Germany has gone up in the first quarter, reflecting on a change around last year. Do you see that continuing, or are the reasons that you're looking at both the UK and Germany more to do with a different kind of investment strategy from your side? Are they reflecting what's happening in terms of these trends, or are you looking at more micro trends in a way?
Well, that's absolutely right, Richard. So it's also the skill set within the business. So we have a lot of depth in those particular markets, and it's opportunity led as well, of course. But you've got to bear in mind that whilst there's an extremely good story in Germany currently, if you look at yields, the UK is actually cheaper. It's actually a higher yielding. So there's pros and cons with both those particular markets. It's very interesting what Damien was saying actually about London. And okay, there's a lot of political risk, but it's still an extremely attractive investor location. You have to bear in mind certain factors like, for example, transport. With Crossrail coming in, it's a huge plus. And what that means is that not only makes London more attractive, that makes areas outside London more attractive. And so there's all sorts of factors that you can take into account in these markets which have an awful lot of depth. And the same thing goes for Berlin. Look at the development potential in Berlin. Look at the opportunity to develop out Tegel Airport. I mean, that area alone is something like 5% of the equivalent of 5% of suburban residential Paris. So you can see the potential in both these markets, and we're looking to exploit those opportunities.
And just picking up the point that Riccardo said there, he mentioned obviously the big drop in currency. Is that having an impact, either positive or negative? Is that making it appear cheaper, the UK versus continental Europe, or is that not really part of your?
That is definitely driving investor interest. I mean, a classic example of that is a building that we sold in the city about it was about five months ago, and we initially launched that. I mean, this is 1 Wood Street. It's Evershed's headquarters. It's probably one of the best buildings in the city, and we launched that prior to Brexit. It went under offer. It fell out of bed as a result of Brexit, and then it came back into the market, went under offer again at about 25 basis points cheaper than it was originally. So that was a clear sign of investors taking advantage of the opportunity thrown by Brexit and also currency. And we're continuing to see that. So we're currently seeing a lot of Middle Eastern money coming into the UK, and that isn't necessarily focused on London. That's focused on regional centres, and once again, that's currency driven, and that's also debt driven as well.
Okay, good. Richard, do you want to pick that up? And you, Robbie?
Yeah, I mean, I just wanted, when you're comparing UK investment volumes with Germany, everyone has to remember that the sort of London commercial market probably peaked in the summer of 2015, and that's when we saw a lot of the international capital keeping away, and we were receiving bids, still getting premium pricing, but there was far less depth of bidders in London. And I think, I seem to be spending every week at some kind of pitch in Germany at the moment, and I think there's a lot of profit takers, and prices have almost doubled. So I think that's why we're seeing, one of the reasons, I mean, obviously the fundamentals in Germany are stronger than the UK, and obviously politically it's more stable, even though they got the elections. But I think there's a lot more willing sellers in Germany compared to the UK.
I think I'd agree with that, Richard. I mean, we actually bought another building in central London, which we put under offer before Brexit, and acquired it afterwards at a similar sort of discount. And we tend to like cities or regions rather than countries. I think our motivation is, again, the usual fundamentals of very low vacancy rates in most cities. We've just bought 2 buildings in Munich where the vacancy rates for Grade A is probably less than 5%, and I think that's a function of very little financing, and particularly in the UK for any development, even if it's got some pre-letting, it's a little easier in Europe, and I think it's really a function that the UK improved much more quickly after the GFC than most of Europe. We like volatility in our value add funds. It creates the opportunity for us to be selective in what we do. The other area, apart from offices, we've actually pretty increased our weighting towards residential quite significantly over the last 2 or 3 years. 10 years ago, we probably didn't do anything. Now, in one of our funds, we're probably nearly 30% residential, which is both funding for rental, but also doing high-end residential for sale in Spain, and doing residential land in the UK, where there is effectively a shortage of supply. Okay, good.
John, I wanted to pick up with you we've mentioned here a little bit some of the risks, also the currency. What's your sense of and political uncertainty was one of the main things that was picked up in Damien's presentation. How do you see that, and how much actual direct impact do you think that has on investment, or is it more to do with the areas that were just highlighted about where we were in the cycle and those kinds of elements?
I would say in terms of where we are in the cycle, we're towards late cycle, but there are still structural changes that are going on that are still very positive in terms of the shortages of industrial and the shortages of residential. I think one slightly more negative change, I suppose, is retail, which I think faces some challenges. You can still do very well if you're in the right parts of retail, but a lot of mid-ranking shopping centres we think face some challenges ahead. Although the political risks get a lot of publicity, I think it's ultimately where prices are that kind of drive investment. Where pricing is, gaps between bond yields and property yields are still positive. There is increasing nervousness about the UK, but that has been offset to some extent by the fall in the currency as well, which is making it more attractive. And the point that was made earlier as well about the dynamism of London, we shouldn't forget as well. It's got a really rapidly growing tech sector. We've seen Apple, Amazon, Google all committing to build big new HQs. There could be a lot of growth in that part of the economy as well, whilst in some parts of financial services we may see some loss of things such as euro clearing, but it's being offset by growth in other areas. I think over the next 10 to 15 years it's got a huge highly skilled labour pool, which is going to be very difficult for other cities to replicate, and it still remains a very attractive place to live.
Okay, good.
I mean, I sort of take a view that politics is all fine and well, but actually technology and the way people work probably have a much bigger impact on occupational needs of any business, and the way we all work, and how many desks do you really need. And I think people understand that they want to meet each other face to face, and therefore when the internet was invented, everybody thought nobody would have an office anymore. That hasn't happened, and who knows where all this AI is going to take us. But regulation may limit it a bit, but I do think people get on with stuff in spite of politics.
Okay, good. And Robin, from your point of view, do you think the uncertainty is actually maybe positive, or do you think uncertainty is therefore negative, but because it's less clear about the benefits of just leaving, that there's a more, well, it appears anyway that there's a more nuanced approach now. Do you think that's more positive in terms of jobs remaining within London, or how do you see it?
Well, just generally, any uncertainty throws up opportunities, doesn't it? So from an investment perspective, I don't see it as negative at all. I think it will have an impact, and I think uncertainty in the jobs area it is going to lead to different type of occupiers. So this is a classic reason why, for example, WeWork are expanding so much, because they're driven by two things. They're driven by the demand for tech space, and they're driven by the demand for flexibility. So whereas in our portfolio we'll have tenants coming to us saying, well, we want to break in year 3 because we don't know what's going to be happening 3 years down the line. If you take space in a WeWork office, you've got plenty of flexibility, and I see this sort of uncertainty just driving the serviced office market, and giving more opportunity to that sort of business. And a classic example of that is WeWork taking 280,000 square feet in Alamacanta scheme on the South Bank. So we're going to see more of that type of occupier. We're going to see more flexibility, and quite frankly, London is a good place to be based if you want to be flexible. It's, as I said, there's tremendous depth to the market, and landlords here, are quite happy to embrace change.
And John, I just wanted to pick up one thing that was in Damien's presentation, but also, given your kind of role in research, we just had higher numbers out for inflation, much of which we assume is imported inflation because of the currency. How much of a risk is that then in terms of the interest rate cycle, whether or not that will lead ultimately to higher interest rates? What's your sense of that? Is that something people should be thinking about, worried about?
I'd be most concerned about this kind of short-term impact on retail in some ways, in terms of, we've still got very sluggish wage growth, inflation rising quite rapidly, falling real wages. We think that's going to lead to a renewed squeeze on retailers this year as well, who are already struggling with declining margins due to the growth of online retail. So that's where we think some of the inflation will have some of the biggest short-term impact. In terms of interest rates rising in the UK and even continental Europe, I don't think that's a big risk in the short term. I think it's more the US we will see more of that, and you've seen the yield gap shrink in the US quite markedly, which we think has been one factor behind those declining transaction volumes. In the UK and continental Europe, there is still a very large yield gap, which is attracting a lot of investors into property looking for income. There's still structural challenges in Italy, in Europe, for example. In Italy, for example, struggling with a huge government debt. A lot of the debt on banks' balance sheets hasn't been resolved in the way it was in Spain and Ireland as well. So I think there are a lot of structural problems in Europe which will mean that interest rates won't rise quickly in the short term as well, which means that property will still have that income advantage. With the uncertainty in the UK as well, I don't see interest rates rising in the short term either, political and economic uncertainty.
Okay, good. And Riccardo, in terms of dislocation, obviously for you, a valuable uncertainty in some ways can be valuable for you in terms of your investment style. Are you seeing any difference between opportunities post-election here versus where they were before? And in terms of the movement of jobs for offices particularly, are you seeing investors looking less at the UK and more at the other cities you're working in? How do you see that?
I think, when we look at our strategy, we try to remove the noise in the market, right? And there's a lot of noise. Some say it's election or some referendums in Europe or other situations. So once you go through that, then you just go behind the numbers, the macro number. You see that it's a relatively benign position in which we are, where the euro is depreciated as well. You have Europe is exporting a lot. The UK itself is still growing. It's a cyclical drag probably, but it's growing well. So in a sense, when I look at the recent results on our investment style, they don't make much of a difference, to be honest. And in terms of, again, looking at jobs in London, which is the other part of the question, there are different trends that supersede that element if you are a real estate investor. Right, and some are cyclical, and some are long-term trends, mega trends. The cyclical element, it's obviously the supply side, which I go back to, which is very, very relevant. If you look at the recent reports in terms of construction, we are, if all the pipeline that is in London goes through, we're going to be back to a supply higher than what we had in 07, 08, and possibly even where we were in the 90s, right? If you look at the demand side, then that's a question about jobs. That depends on fundamental GDP growth, because the demand for office is a function of GDP growth. Now GDP is muted, you have different views, so probably there will be an impact. Now, but the bigger element is really how people work, what's the density in office space, and that has changed massively. And if you look at that element, that is what we focus on as well, because the amount of people you can get in an office, the flexibility of that space, the flexibility of contracts, is the 20-year lease still applicable here, yes or no? Do we want more services? So that's where we're looking into. And so if you put that into context, the short-term changes are, for me, less important than what you see long-term and in our strategy.
Okay, good. Did you want to pick that up, Richard, or you? No, fine. That's because you are Scottish, Rob. I'm going to come to you briefly just on uncertainty in terms of Scottish referendum, but also Ireland, also other areas. How much of that do you see as genuine? Do you think that throws up opportunities, or do you think that's just going to continue uncertainty, maybe from international investors, which perhaps may give you more of an opportunity in Scotland, the UK?
Interestingly enough, I think international investors probably care less about what happens between Scotland and England than people in Scotland do. I've lived down here for 30 years, so I've lived here longer than I ever lived in Scotland, but it doesn't change where I'm from. It clearly has had an impact. There's been a lot of, particularly UK funds have, some have openly said that they will not invest in the Scottish markets. I think that might change because I think the results of the election last week or the week before, it clearly sent a message to the Scottish nationalists that they didn't win their referendum, and in actual fact the mood for an independence I think has moved away. I think 60% of the electorate who voted on the 8th of June were voting for parties who are unionists. So I think that might diminish. We have been active in acquiring in Scotland, not because of me, because we find interesting opportunities there. And there has been a margin on the yield because of that. But people need to eat, work and sleep in Scotland as they do in any other part of Europe. So I think it's a short-term issue. The UK generally, I think, has seen obviously a significant reduction in investment volumes. That's partly, I think, because there has been less on the market because people are waiting to see what happens. But I think for the rest of this year, I think volumes in the UK will be lower, and probably lower than last year even, which is obviously having an impact over on the European market volumes. And I think yields in the UK are more likely to go up slightly this year. Which is probably contra to the rest of Europe, particularly Germany and France, where we are seeing extraordinary yields being paid for even buildings with very short leases, which is not the case in the UK.
Okay, good. Richard, I just wanted to pick up with you. Whilst we've got an element of uncertainty here, France, on the other hand, has been pretty clearly demonstrating in terms of its politics where it sees its future. Do you think that's now, and also that future looks as though it's going to be more business friendly to a certain degree, and removing some of the regulatory inputs? Do you expect to see a bigger pickup now in France because the uncertainty has gone? How do you see that market?
Macron's obviously a good thing, but it's a new party and he hasn't got a majority in the election yet. So I think in the short term, he's got to get people to support him. But, what I'm seeing from an international perspective, a lot of people are finding Paris and places like Berlin and Munich very, very expensive, and it's all to do with far lower finance costs that people can do it. But it's also the French and German pension funds, retail funds, are, as we had gating last year after the EU referendum in the UK, I believe in Germany they're stopping people putting money in. I got told the German pension funds are 20% richer this year and back to 2008 levels. So I think they're very, very dominant in those markets. And people who paid premium pricing in London, so for example like a Fubon Life, is finding those markets very, very expensive and doesn't necessarily want to go at the risk curve. But yeah, I think it's a good thing for Paris. Damien was talking about the latent supply of labour there. It is looking good, but how France changes its culture overnight, I'm not quite sure how long that's going to take.
Okay, interesting. And Rob, Amsterdam wasn't really mentioned as one of those cities that may benefit. So within your chart, there was slightly Brussels, there was slightly Luxembourg. Is that your sense, Rob, as well? Because I know Amsterdam was quite keen to be attractive to potentially some jobs coming from London. Obviously, Netherlands part of your beat. Do you think that's correct? Do you think they've lost out there, or that they were never really a contender?
I think they're more tech-related economy rather than finance. There are obviously some big financial institutions. I think the problem the Netherlands has had is that Amsterdam has dominated so much over the last 5 or 6 years to the expense of the other Randstad cities and smaller cities. I think that's starting to change because Amsterdam is running out of grade A space as well, and it's starting to reflect, but it's been very, very slow. I mean, there's still a massive difference between very prime real estate in Amsterdam and everything else, and I think that will take some time. But I think for the big finance companies looking at alternatives, there isn't really the available stock for them to be based in, and I think Amsterdam's a slightly different market to that.
And the other thing I just wanted to pick up is, John mentioned obviously Euroclear, but fund administration services that are currently UK denominated, let's say. Do you think that's going to move far more to Luxembourg? Do you think Luxembourg will be a winner from that, just in terms of how funds will be managed?
I suppose our experiences are all our fund administration is either in Luxembourg or Jersey, and is not in the UK, and that's the nature of our business. So I wouldn't really be able to comment particularly on, is that likely to change because of coming out of the European Union. I think European funds are always generally run outside the UK anyway. UK funds will probably still be based in the UK. So I would be guessing, but I don't see that as such a major impact as the banking industry, who specifically obviously have to have the appropriate licenses to trade in Europe. Okay,
good. Robin, I wanted just to pick up with you in terms of the capital that's looking, both at the UK but also at Europe. Are you seeing different trends in that, whether or not there's new capital coming in? What's the situation of the people who are kind of maybe coming into your funds or looking? Are you seeing different sources of capital being attracted to the market?
Absolutely. I mean, there's a tremendous range of capital, and it's constantly changing, of course, as well. So you can see that currently in the City of London, where we're seeing a lot of Chinese money coming in. We're working with a lot of Middle Eastern money, actually, which, as I said to you earlier, was driven by the currency benefits, and once again, the advantage with the debt. You've also got the US money, which is to a certain extent sitting on the sidelines. But if there's an opportunity which is where the IRR is up in the high teens, you're going to attract that money. Very opportunistic driven. So there's a whole range of capital out there just sitting on the sidelines waiting to come in, and so we're working with quite a bit of it.
Okay, good. And Richard, what's your sense in terms of that mix? If we're keeping if bond yields are going to be low, then more capital is still going to have to come into real estate to a certain extent. And you mentioned as also that if you've got a huge amount of capital still being built up in Germany and elsewhere, where do you see the sort of dominant sources of capital coming from over the next, over the second half of this year?
I mean, we've mentioned the North American money. I think what we're seeing is that more opportunistic pools of money going more to core plus. So Europa as an example, probably looking at low teen returns rather than higher teen returns. And some of those big deals that have happened this year, Blackstone have raised this and they've bought that, etc. The South Korean insurance companies are very, very active in the UK and Europe and are paying premium prices. Robin mentioned the Chinese and Hong Kong money that's particularly coming to London. But on the global call I was on Tuesday evening, there's definitely a feel that some of that Asian capital wants to go into continental Europe rather than the UK. And I think that's a need to diversify. A lot of the guys have had success in London. We mentioned the Middle East capital. It's definitely coming more from Saudi Arabia, and probably with Qatar being linked to terrorism, I imagine quite a lot of family office money is there. They come over to London, they spend 3 months here for the summer. They don't generally leave until they've done something. So I think the next few months they'll be fairly active. And, obviously we're seeing this continuation of South African capital trying to get out of its country and put it into predominantly UK and Central and Eastern Europe. And but we're starting to get inquiries for Western Europe from that type of capital as well.
Okay, good. And in terms of the sort of discussions, there's been a lot about a move towards secondary and that investors are having to take more risk. Do you think that's going to continue over the next 6 months? Do you think more people will be going into those secondary cities? Is there more demand? Is that where people have to go in order to get the returns that they're looking for?
I mean, I think it just depends on which country you're in. So, I mean, last year we were definitely getting a feeling of liquidity, that famous word raising its head, and a lot more capital rather going up the risk curve in the more liquid cities. But I think, fundamentals in Germany, pricing in Germany, for example, is going to lead people to have to go to those second cities. But yeah, I mean, going into the sort of periphery countries, it's still very focused on just those capital cities. I mean, Helsinki is getting a lot of attention at the moment as a location. Budapest, for example, is getting quite a lot of investors looking at that, particularly for offices. So Portugal's getting a lot more capital that's coming in. So some of those markets that probably haven't been on the map in 2016 are starting to come through.
Okay, good. And Riccardo, in terms of your view on the market, those kinds of secondary cities, tertiary cities, are you looking at those as I'm interested in this particular city, or is it more to do with stock selection or niches that there are in, that residential in this is a particular, in this city I'm only looking at office, not residential? How do you see that, and are you moving more towards those kind of secondary cities?
There was an interesting graph about the US yields that you showed. That's the movement, I guess, from only gateway and cities as something more into a broader market, right? And if you look at this yield spread between prime and secondary in the UK and across Europe, you still are significantly higher than long-term average, which means that so far the market has not yet completely tapped into that in those secondary markets. Now, on our side, we clearly look at secondary location. We look at cities with very strong demographics, with the right level of supply. So we, even within the UK, we select the cities which we like more than others. So we would do some cities, but not others, and the same rates the sectors. But what we noticed, though, is that there is actually a premium to going early in those cities and doing the work, and then fixing the properties, and then making it more of an institutional product. That's what we do. And the same applies across Europe. So we recently bought something in Denmark, which is doing really well for us, and we entered in cities which at that time were probably not as liquid, right? But as we enter, we fix the properties. Now you find liquidity as we go through, and in that sense, we clearly look at those assets. We look at cities more than countries, and connecting to what Europa said as before, because at the end, there are very strong cities in weaker countries and very weak cities in strong countries. So it really depends on a stock selection, on asset selection, and we look also a lot at alternatives. It could be healthcare, it could be data centers, and as well as hospitality. So that's also something which we're doing a lot of work, we're investing into, as those are trends which go beyond your traditional, 3-4 asset classes we have, and therefore they present very good long-term opportunities for us, and to create institutional product that then we can sell on to institutional investors.
Okay, good. I'm going to dig into the sectors in a minute, actually. But Robin, I just wanted to come to you in terms of the regional UK story. Who's buying that and why? And do you think there is a move more towards those kind of regional, larger cities? What's your sense of that?
Well, first of all, we are. So we're very focused on the regional centres, and I think there's a big demand for those sort of locations. Why is that? Because you look at centres like Manchester and Birmingham, and you see, particularly in Manchester, great vibrancy. So as an alternative to London, Manchester now is a very credible alternative. You look at Birmingham, you look at the massive move by HSBC, HMRC, PwC, HS2, HQ. You know, there's tremendous demand for jobs in these centres, and you look at occupational costs. And the other thing you look at is you look at the impact of infrastructure. So take a centre like Cardiff, doesn't normally rate terribly highly on investors' lists, but come the arrival of the Elizabethan line, you'll be able to get from Cardiff to Canary Wharf in under 2 hours. And I think things like that are really driving interest in these regional centres.
And so infrastructure is driving a lot of that change in terms of perception of these markets.
Very much so, and also the different sectors that are focused on these markets. So once again, it's tech. So even in a centre like Cardiff, where you've got a very large university, you've got a surprisingly highly educated workforce, you're seeing quite a strength or quite a growth in the tech market in that particular location. So that is an obvious attraction for an investor.
Okay, good. And John, in terms of the fundamentals, how do we see things like occupier rates? How do we see rental growth? What's your sense of that across the UK and continental Europe? Do you see those as upward trends?
I think most cities in continental Europe are seeing some upward trends. Some office rents are generally ticking up. The one I'm most nervous about is London, I suppose. The residential sector across continental Europe is seeing rental growth in almost all markets now. Again, London, I'm a bit more cautious in the short term about both where yields are for residential in London and also rental growth prospects. I think that looks a bit toppy at the moment. We could be in for difficult year, but some of the regional cities, I think the yields look much more attractive and the rental growth prospects look a bit stronger. I agree with the comments about some of the regional cities, Manchester in particular, really improving, some stronger opportunities there. A lot of the residential markets suffered much bigger downturns and were slower to recover in continental Europe, but now they're recovering very rapidly, such as Madrid and Amsterdam as well, and we think that there's more to come, I suppose, and in the German cities as well, we think there's much more rental growth to come as well. There's a big supply-demand imbalance there.
And I wanted to dig down a little bit into residential, which seems to be one of the flavours of the year, both picked up by you, Damien, along with industrial and logistics, but also actually reflected here on the panel, the number of people who said one of their areas of interest was residential in one form or another. What's driving that for Aberdeen?
For us, I would say, in terms of long-term structural trends, I suppose, within the sectors, we think there's some negative ones for retailing, with the growth of online retail, downward pressure on pricing, retailers' profit margins falling. I think store portfolios will have to shrink. There are certainly centres which will still continue to do very well, but retail has historically performed very well. We think it could be in for a bit of a tougher time in the future. But residential, a lot of the major cities that we're seeing across Europe, in the UK, we're seeing the populations grow quite rapidly, and due to planning constraints, etc., we're just not building enough housing to accommodate them. We think that's positive for rental values and capital values going forwards. We think there'll be a lot more renting going on, institutionally owned renting. We think that will evolve as a sector in the UK, as it has been commonplace for many years in the Netherlands and Germany as well. So, yeah, big structural positives, I think, for the residential sector.
And Rob, for you, Netherlands obviously has had, for the last 3 or 4 years, structural changes within the regulatory side and what the government is doing to try and push more residential out of social housing in that way and more towards a traditional residential market. Where are you seeing opportunities in those sectors?
In residential, we haven't done anything in the Netherlands yet. It's becoming quite expensive. A lot of these larger portfolios, yields for us looking quite low, and not convinced of tremendous rental growth. Some of that is still regulation. We're doing a lot in Copenhagen. We've seen over 10% rental growth in the last 12 months, and actually we just sold our first 2 assets there. But ours is a combination of looking for value-add opportunities where we are buying it at discounts of sort of low-end housing in the UK from some of the loan portfolio sellers, to long-term income. And I think that's really feeding the appetite for pension funds who want long-term stable income streams. And I think there was comments before about where bond yields and where interest rates are going. I think we're in a, this isn't the next 6, 12, 18 months. I think this is a long-term phenomenon, and investors now accept that with better management of residential, they can actually generate 4% per annum plus indexed or inflation-related rents, and actually in most of the popular cities around Europe, there's a shortage of it, so you may get a bit more. So for us, it's a balance between some opportunistic investment, but I think we see it as a long-term, stable investment. It's got less obsolescence in retail or indeed the office market. I think it'll grow.
Okay, good. And Robin, one of the big mysteries about 4 or 5 years ago, whenever I was talking to a US audience, was why is there no multifamily in Europe? Why don't you have it? What's the matter with you? And now, obviously, you can see from that chart that there was, but the residential is beginning to be more of that investment case from your one in cities. What's your sense of that? I mean, in the US, obviously, you've had that move from multifamily into senior living. Do you think that's a natural progression? Do you think there are opportunities there for Europe especially?
Well, we are in multifamily in the US. It's a lot easier to get into that market than it is in the UK, and I think that's probably one of the reasons. It's just difficult to get that sector started. But yes, I see very strong potential for multifamily, and then leading into senior living as well. I mean, you've only got to look at the impact that PD has had on the southeast. I think that if you look at the figures there, I think you're talking about sort of 16 million square feet that's been, 12 million square feet in central London has been converted under PD, and 16% of the schemes in southeast that have gone from office to PD. So yes, multifamily is a natural progression. It's just getting that market kick-started, and I'm not entirely sure how that happens.
Okay, good. And Riccardo, you mentioned senior living especially. Where do you see the opportunities in that, and how do you see that developing in terms of an asset class?
Well, I mean, in the US, connecting to the US, that entire sector is fully developed. Entire healthcare chain in sense of real estate. It's concentrated in a number of large REITs, which last time I checked, that a market cap close to 100 billion. Right? So it's a huge sector. So now in implementing this in Europe, it's quite complicated, as fundamentally you have to create the product, and the product is not homogeneous across countries. So clearly, using some tools, some planning tools to help to do that, and creating the right product is probably the way. At the moment, the product that we have seen in the market tends not to be the right product if you want to build institutional quality type of senior living or retirement homes or that kind of product. So the route would be fundamentally developing the product, and that's something which we're investigating, even though we haven't yet found the right angle here.
Okay, John, you want to speak that up?
Yes, in terms of residential generally, in terms of finding the right product, something that we're doing is we're essentially just building it ourselves, because we can't find a lot of the product out there. So to get the kind of quality and specification that we want, to make it as efficient as possible in terms of the gross to net leakage, we're having to do that. I mean, we're doing that predominantly in the PRS sector in Germany, where we've done over 100 PRS residential developments in the past 5 years.
If I may, it's a question of operations, right, at the end. And if you don't have the right products, the costs are too high, the net to gross is too high, and therefore, fundamentally, the equation doesn't stack up. You need to have a product which actually can be operated really well. It becomes an operating business. And we're looking with our private equity friends and colleagues at these strategies. But it needs to be done right. Otherwise, you end up, if you patch a few portfolios of the wrong product, you end up not being able to operate it in the right way, and hence you don't get the right product for the client, but at the same time you don't get the right investment product.
Yeah, go ahead, Richard.
I mean, just to add, obviously we in the UK we've got this weak leadership at the moment, and we're going into a weak coalition. And I think we're on our 4th housing minister in the last 5 years, and that's a big concern, because what we really need is someone to come in and really sort this out. And we just haven't had that yet. So it'd be interesting. I can't remember the chap's name, Alok, someone who got appointed yesterday as the new housing minister, to see what he's going to do in the UK.
And how long it'll last. Here you go, Barry.
Hello, it's Barry from Sasona Real Estate from the Netherlands. I've got a question. This week I was looking at technology that's coming live. It's called Hypertube. It's actually a tube where it just transports people as consumers at the speed of sound. It's live on the west coast of the US. It's implemented in Abu Dhabi, and it's coming here to the UK. I'm just wondering, what is this serious? What would be the impact if you get from here to Edinburgh, London to Edinburgh in 10 minutes, and it pays for itself because it generates electricity which is sold? Is it serious? What would it do to you?
Yes, I think I saw the same article as you did. Yes, I mean, it's massive, isn't it? There's absolutely no question about it. It's massive. I mean, we're just seeing, sorry, harking back to Crossrail again. I mean, that is probably the biggest piece of infrastructure to come in 40 years. You bring in something like that, I mean, it's a complete game changer. But that's the sort of thing that we should be looking at. That's where we need to see the investment. It's infrastructure. And something as extreme as that is going to make a phenomenal difference.
Slightly more depressing, I was talking to one of my colleagues, Jessie, who's a lot younger than me, and she was getting worried about what her children and grandchildren are going to do, given that I think she'd read an article about AI and robots basically just taking over huge parts of all our lives, and therefore what are humans actually going to be doing to earn a living and look after this obviously increasingly aging population. And that's and it was in 2045, which is 30 years away. Maybe I wouldn't have to worry about it, but that obviously has a function on the built environment, as well as how do we fund our pension schemes if people are not doing the jobs they're doing now.
Somebody touched on urban logistics. Just wanting to understand, where are you seeing the opportunities in Europe, and what type of assets are we talking? Multi-led industrial? Are we talking cross-docked parcel delivery centres, urban delivery centres? What do we mean when we say urban logistics?
I can have a go if you like. I mean, one thing we particularly like about urban logistics, I think, is the demand-supply balance. I mean, with logistics generally, there isn't much supply constraint for the out-of-town logistics that you can build across alongside motorway junctions, I suppose. But in major cities, there's a huge amount of competition for land use, and logistics and industry is often the cheapest valued land use, which is beneficial to owners of that product, in that sometimes that stock can get converted to residential, so there's a potential for long-term capital uplift. And despite the strong growth in these cities, the stock is actually shrinking, which makes me think there's, and the evidence we've seen as well, is there's much stronger rental growth on logistics within major cities, and a lot of it is the demand is coming for parcel delivery hubs for online retailing as well. But there's also a lot of these multi-let industrial estates are needed just for cities to survive in terms of food processing, building materials within these cities. And we can't build any more of it because it doesn't stack up often compared to other types of property, which is much more expensive. So the supply is shrinking while the rental growth is strong. And online retail, I think, is great. Amazon are building a lot more of their distribution hubs within cities for this last mile delivery as well. That's something we're seeing in the States, and I think we'll see much more of in Europe. So I think it's another long-term positive structural trend, I think, for that type of property.
And one thing, Richard, we've been talking about a little while for a little while in these is that as you get more of that kind of move towards inner city urban logistics, that what you've got actually in quite a lot of areas, particularly around these cities, is you've got light industrial, which was often at a much lower price point than other areas. Do you think that's now an opportunity? I've seen that some of the pricing for that is ticking up. Do you think that's because people are buying that with that view in mind of urban logistics actually taking a lot of that space?
I completely agree with John. I mean, I think going forward, it's going to have to be more mixed use. Maybe some parcel force companies together with residential next door. I think because, as you say, the value in alternative uses is quite often higher. Everyone's talking about it. Everyone wants it. But very like PRS in the UK, there's not much there to buy. And, until this is built out, it's a bit of an issue for a lot of people.
mean, what they've done in Japan is they've got multi-story industrial. If you ever have the opportunity of going to Tokyo, there are 5-6-story industrial buildings. You're very close to the city centre. I mean, it's an enormous city, but that may be how you create the value out of it by actually stacking industrial uses. I mean, it's not something that I think it's been done at Heathrow, but pretty much anywhere else in Europe it's not been done because we have enough land. I think to answer the question that was asked as well, where's it going to come from? Some of it will be existing light industrial. I think maybe some of these failed retail parks might get converted for that sort of use, because I think some of these logistics hubs are actually much cleaner uses than the old manufacturing. So again, the perception of it being an industrial estate compared with actually somewhere where the public can go and pick something up as well as smaller vans and trucks might come to fore.
Okay, good. I'm going to try and make us finish on time, which means I'm going to ask you our traditional question, which is, where should these good people invest? What's your top pick for the second half of the year? And on top of that, you can also tell me if you think that there's a deal that may well be the deal of the year already this year, for when we look at that at the end of the year. Rob, I'm going to start with you. Where
I don't know does that make it a good thing?
Where should we invest? And any deals that would make the deal of the year for you?
I like regional offices in the UK at the moment. The yields are quite attractive. They're still well above London, and they're probably well above most equivalent cities in Europe. So we like that. Income producing, but with opportunities to re-gear and extend. The occupational market is quite good. Deal of the year, it's probably one that maybe a lot of people mentioned. I mean, I think the Blackstone sale to CIC of the logistics is just such a phenomenally large, but actually interesting, given that that's a Chinese business which is obviously delving into all sorts of different parts of not just real estate, but the industry as a whole. So I suspect that might be up there at the end of the year as well.
Okay, John.
Okay, in terms of where would I invest, I'd probably split it into three. I would go for urban logistics. I would go for PRS in continental Europe, major cities, for very secure income, which will grow in line with inflation. For many German institutions will like that. And for something a bit more higher returning, I'd go for office to residential conversion. We've still got a surplus of secondary office space in many cities and a shortage of residential. In terms of deal of the year, that's a good question. I was thinking, maybe one that I just thought was interesting was Blackstone's acquisition of Sponder, the Finnish property company, just because Finland's quite a high-yielding market. It often gets overlooked as well. So in an environment where there's a hump for yield, I thought that was a very interesting one.
Okay, Robin.
Well, look, I like to walk into an office building, consider it's going to be vacant, and feel enthusiastic about letting it. So my top tip is going to be something that's tech-driven. It's probably going to be a regional centre. Actually, it's probably going to be somewhere where there's going to be a significant infrastructure change. I've mentioned a couple of locations already. In terms of deals, I'm going to go for an occupational deal. I've mentioned it already. I think this WeWork deal on the South Bank, 280,000 square feet, is a cracking deal. I think it's a really good indication of how the market's changing, and I think that's really positive. That a traditional landlord is grasping that with both hands, and I see that as great news for the London market.
Okay, good. Thank you, Riccardo.
I'll stick to the Nordics in terms of infrastructure, logistics, industrial, and office. Also in the UK, residential, permitted development mostly, but also Spain. So 2 residential kind of positions. In terms of deals, Logicor.
Okay, Richard.
Well, everything, as we've mentioned, is industrial, logistics, or residential. As a top tip, probably Spanish logistics, if I had to pick somewhere. They seem to be the furthest behind on e-commerce in Spain. So I think a lot of people have seen what's happened in the UK, sometimes missed the trick there, and feel it's probably a good time to get into Spanish logistics. In terms of deals, obviously, logical. No one's mentioned the Blackstone acquisition of First Office off H.I.G, which has given them access to 160 offices in Germany. But it's my time to plug our deals, really. So, we took the Italian Dentists and Doctors Fund out of Italy for the first time to do the Amazon headquarters in London. We've just done the largest transaction in Bucharest, Afi Park, for about 164 million. And we did the largest Four Seasons hotel with development of high-end residential and retail in Madrid, which we sold to Mark Scheinberg, who's the owner of PokerStars, which is the biggest deal in Madrid this year.
Right, thank you. Thank you to yourselves and also to the panel. Thank you.